Hi, my name is Bella Carrasco, and helping others feel confident about investing brings a huge smile to my face. After working in the private equity, family office, and securities markets for nearly a decade, I am breaking down the world of money, investing, and financial freedom. Work optionality isn't a dream, it's a decision you make today. I bring you actionable tips, expert interviews, and enlightening strategies to help you get richer and stay that way. This is the How Do You Know podcast. And this podcast is for informational and educational purposes only and does not constitute financial advice. Please consult with a qualified financial professional for advice specific to your situation. The views and opinions expressed are those of the hosts and guests and do not necessarily reflect those of the podcast producers or sponsors. We make no representations or warranties regarding the accuracy or completeness of the content. Today, we are talking to Mike, who is currently Chief Growth Officer at Bonaventure, where he's growing their 1031 platform. But over the last 10 years, he's worked in acquisitions and investment for multifamily real estate, where he's been a part of teams that have underwritten, sourced, and managed over $1 billion in real estate. And most recently was educating the masses on funds during his time with a qualified intermediary company. Needless to say, he has seen a lot when it comes to 1031s. So, Mike, first, thank you so much for your time today. Second, what is the most efficient way to explain a 1031?
Yeah, thanks for having me, Bella. I think funds are really simple. It's really just swapping a piece of investment property without paying a dime in tax. And so like when you think of doing a 1031 exchange, that's really what it's all about. And I think sometimes people get into the weeds, but the goal is really to defer tax on your capital gains. And the most, I would say, not only qualified, but some of the biggest families in real estate have been doing it for generations and decades. And that's really how they've compounded and built their wealth over time.
Yeah, it's hard to ignore when the wealthiest families are using this. So there's obviously something there. Is there a common misconception about 1031s, or what do most people get wrong?
Yeah, there's a lot. I'll go into a couple. One, I think a lot of people when they hear the word like kind, they immediately think like, oh, I'm selling a single family rental. I have to buy another single family rental, and I think that really confuses people. Like kind just means investment property, and so as long as you purchase an investment property and it's not your personal residence or you spend more than 14 days out of the year there, you can do a 1031 exchange. The other thing I think that a lot of people get wrong or biggest misconception is that all the net proceeds need to be reinvested. Like in reality, all the net equity and debt retired on a relinquished property, needs to be reinvested for the replacement property. But a lot of people take money out to pay for medical expenses, college, life events. So you can do something called a partial 1031 exchange. And I've helped a lot of investors do that over time. Talking to a qualified intermediary is what people should do before they close. That's the last one that I'll say, because we get
Mm-hmm.
we used to get a lot of calls from people saying, hey, I closed my property yesterday, I want to do this 1031 thing, and
Oh
sorry,
no.
like you can't do that because the funds already hit your bank account. So those are my three biggest misconceptions that I think people should know about.
I hear those a lot too. Definitely the qualified intermediary concept is one that I forget because you should know that when you're selling and want to do a 1031, you know that you cannot receive receipt of the funds, but it truly is a misconception. People don't realize that that's a necessary step. So when you're considering working with a qualified intermediary or QI, what are the best questions to ask them?
Yeah, I would just ask them, like, just like any service provider, like what's your process, and how do I make sure my funds are safe and secure? I think there's a lot of people in this industry that have like an attorney or a CPA that has done this in the past, and they don't necessarily take the best quality controls to make sure your money is safe and secure. And what I mean by that is, you know, it costs money to open up a segregated trust account, a bank account in the investor's name or the LLC's name, where the funds go after closing. And some CPAs or attorneys will just have one slush fund account where they just keep all the investors' money in there together. And that way, it's not necessarily the best thing for the individual investor to make sure that their money is separated from everyone else, right? So I would
Yeah.
ask them that. And, I think another thing is just like their experience in real estate, I think is really important. Obviously, working with CPAs and dedicated professionals is super important. But I think today, like, it's all about like, will people spend the time on the phone with you to answer your questions and be personal? And I think that really
Yeah.
goes a long way. And it's not always about the cheapest. It's sometimes it's about the people that add the most value. And you can spend a couple extra $100 to make sure that you're compliant with the IRS, and it's well money spent in my in my mind.
Sometimes you get what you paid for. So if it's cheap, it might be cheap for a reason. So I'm glad you
Totally.
brought that up. Aside from questions to ask your qualified intermediary, there are a ton of different 1031 options out there. You can 1031 and find a property yourself. There's passive ways to do it. So what would you say are two key things people should look out for when they're considering a 1031?
Yeah, I think it all comes down to the personal investor and what their goals are, right? Like we talk about different vehicles. There's DSTs, Delaware Statutory Trusts, where you own a fractional piece of ownership in a large institutional quality asset. I think a lot of people now are, thinking about the idea of more passive ownership, but really, like, it comes down to control and decision making. And I think for an investor, even though things may seem, one way, like, they have to consider, like, hey, what are my main goals in the next 5 years? Like, do I need this money? Do I am I in a partnership? Like, do I want to go my own way? Like, there's a ton of different scenarios, and so, I think as an investor, like, the best way to always do it is to set it up either in an LLC or a tenant in common if you have partners, so you have that optionality in upfront and in the future. Otherwise, you have to jump through some hoops, which can be done, but you just want to make sure that you maintain that flexibility for the future. And a lot of times people don't necessarily think when they buy things that partnerships will end or marriages will end. And we all know that sometimes, like, nothing is forever. And my advice would be to just think whenever you buy a piece of property, like, worst case scenario, because it could happen.
I think it was Keller Williams that said you need a disagreement. What happens when you disagree on things? Because it's easy if everything's going according to plan and it's all rainbows and
Totally.
butterflies.
Totally.
Talking about thinking about the future, how should investors align a 1031 exchange with their long-term goals, whether that's diversifying, retirement planning, even shifting markets? Any advice there?
Yeah, I think Charlie Munger said it best, like, compounding is the eighth wonder of the world. And so a lot of
Mhm.
people think when they get a windfall or they're selling a property with a huge capital gain, like, great, I'm going to get 5 million. Well, after you pay the tax, like, what are you going to do with that money? Oh, well, I'm going to reinvest it somewhere, right? So I think,
Mhm.
the greatest thing about 1031 exchanges is, like, you can do something called swap till you drop. And having exposure to real estate with all the benefits sets you and your family up in your line of succession really well. So the greatest families, the greatest dynasties that I mentioned earlier, they've
Mhm.
really done the 1031 in a tax estate planning tool. So they will keep buying and buying and buying and swapping and swapping and swapping, not paying a dime in tax. Then, when their time on earth is up, their heirs will get a step up in basis, and the lifetime of appreciation that they made happen. And when their heirs go to sell the next day, they won't have to pay a dime in capital gains. So, that to me is something really important when it comes to alternatives. I think, real estate in general has performed really well, considerably well, and it's safe. I think where we get in trouble is we want real estate to values and deals to go up as fast as possible. But traditionally, it's been a long, slow, growing, safe asset class. And I think we need to get back to that today, because the last 5 years with COVID and everything, like, people have gotten into this industry for the wrong reasons. And I really believe, and I think a lot of experts agree now, that owning assets are going to be really important to build wealth in the future. And investment real estate is no different.
Morgan Housel, who's has the famous book Psychology of Money, just came out with a new book, and he was on a podcast recently talking about it. And he mentions what you just said about it doesn't have to be a sexy investment. Sometimes slow and steady will win the race. So even though tens might not feel like a really exciting VC fund, or I'm investing in a franchise that Shaquille O'Neal is sponsoring. Sometimes it's okay to be boring. Boring investments can be good.
Totally, totally. Yeah. And look, I think like let's not overcomplicate things. Like I have friends who've
Mm-hmm.
gone into a number of crypto assets and, trying to get outside returns.
Yeah,
And, most of
exactly.
those things, I would say most, right? Most of them pan out to zero, whether it's meme coins or other things. And I think real estate is tangible. It's something where people, tenants or people, including multifamily, are going to need a place to live. And that gives more comfort than something that was just, the Mike coin, that I created and it trades and then all of a sudden it crashes and, you can't really
Mm-hmm.
even, you know, see it, feel it, touch it, any of that stuff. So I agree with you. I think we just need to keep it simple in the future. The problem is we're just overloaded with a lot of different information and everyone,
Yeah.
you know, wants the quickest way today.
And like you said earlier, that hurts your compounding, and compounding is no doubt a very powerful tool. So that's what I like about 1031s the most is, again, like we were alluding to earlier, the wealthiest families are strategizing around taxes, because if you pay taxes, that's money that you'll never see again. Where if you keep taxes in your pocket, you can continue to invest that and allow it to compound on itself, which, like you said, Charlie Munger has said it's the eighth wonder of the world. The number one rule of compounding is never to interrupt it. So people hopefully should seriously consider tax programs like 1031s.
Yeah, and I think like if you're thinking about from a real estate perspective, like everyone like to be effective, you should buy with leverage, meaning debt,
Mm-hmm.
right? So the more equity you have, the larger properties, the more diverse properties that you can buy that generate more cash flow, more depreciation, all these things that can help generate more income and just with less equity, less after tax dollars, like you're gonna be able to afford less basically, right, assuming all things equal. So I think when it comes to the 1031, like it is shocking to me, Bella, like shocking to me, like this is not the default option in investment real estate. And I think the reason why is because people are lazy in the
Yeah.
fact that they don't want to plan. I think planning is really
Yeah.
hard for a lot of people. And
Yeah.
the people complaining about the timeline, it's like, well, when you're talking to your broker and you decide you want to sell your property, start looking for, replacement property. The clock hasn't even started yet. Like instead of 45 days, maybe you have 6 months, right? So
Right.
I think we just need to do a better job as an industry of making this simpler for our partners, brokers, advisors, CPAs, but for the investor, it's like no one likes paying taxes, but like
Right.
they don't take the 90 minutes to just determine if I should do this thing or not. And it's literally just a 10-minute phone call with a qualified intermediary or a tax professional or you or me or someone just to say, hey, like, you know, that $4,000 capital gains tax, like that could turn into 2 million over the course of however many years if you don't pay the tax right now, right? So I hate the word educating because I think everyone says educating. Yeah, we just got to educate. It's like, well, we got to educate in a way where people like listen, and I don't think it's really been done effectively yet on a massive scalable level because otherwise, like people would be like, man, like why should I pay the tax, right? And I think part of it
Yeah.
is this timeline thing. Part of it is just maybe inventory for sale, like not agreeing with the return threshold. But I mean, you know, if you're going to buy a property, Bella, and you are going to value add the property, which means rehab and renovation, and then the property appreciates, and it takes 5 or 10 years, like you're going to give away 30 to 40% of your profits like overnight without even thinking about it. Like that to me is like you're doing all the work and not really recognizing any of the gains. So it's just interesting to think about it that way.
It's just A, again, people don't know that 1031s exist. And then B, to your point, the gross education word, just people don't know how to be guided through the process either. So sometimes it's just a little bit of ignorance, and just have to keep getting the word out there and helping people understand the process a little bit more. But like you said, it can be overwhelming and cumbersome, especially when you're on this 45-day deadline that you have to identify 3 properties in.
It's just bizarre. I mean, it's been around for 100 years. Like last
Mm-hmm.
time I checked, every person I know doesn't like want to pay tax, any more
Yeah.
tax than they already have to. And so, like, if you're going to stay in real estate, I think the 1031 is great for people staying in real estate if you want that exposure to your portfolio. But if you're not, then you can pay the tax and go somewhere else. But if your plan is to
Hmm.
always stay invested in real estate, the 1031 should always be the tool, the mechanism to always be able for you to get to your goals quicker and compound faster.
And maybe if you don't want to be in the day to day management anymore, that's okay because there are passive ways of doing that. I know that fees and additional costs can be cumbersome if you go the passive way. So, what should investors expect when facilitating a 1031 exchange in terms of cost?
Yeah, definitely. So I think when you're doing a standard 1031 exchange, you're working with a qualified intermediary. Like maybe it's $1,200, right? Like it's super. It's very very small potatoes compared to when you sell your property and it's 5%, 6%. I'll say that obviously other transaction costs that aren't related, title fees, the standard fees with the transaction
Hmm.
are involved. Now, what you can do when you do a 1031 exchange is you want to get to something called your net selling price. So let's say if you have a property that's on the market for $1 million, you've got an agent or a broker, they charge 5%. You're allowed to have something called an allowable expense where you get to I wouldn't say write off is that's not the right term, but the net selling price of what you have to defer, it all gets calculated from there. So instead of like buying something that's greater than equal to $1 million, it's $1 million minus all title fees, transaction costs, broker costs, all that stuff. And so you can it'll reduce the amount of equity that you have to, or the amount of replacement property that you have to go out and buy. So it's really a great tool to help investors, and I think they just don't know about it because on a national licensing level, it hasn't been taught yet. I was working on a pretty big initiative, and I think it's going to happen to get that done. But really, once these people know and do the math, right? Like I think that the answer is pretty clear if they want to stay invested in real estate.
What about depreciation recapture? That's a common question that comes up with 1031s. If people have depreciated their property for many years, does that get netted out of the selling price as well on top of the title fees and broker fees?
Yeah, so there's four layers of tax when someone does a 1031 exchange that they get to defer. And this is like the simplest way that I explain it. And so there's federal cap gains tax 15 to 20%, depending on what tax bracket you're in. There's
Hmm.
state income tax, California 13.3, states like Texas, Florida, Tennessee are zero. Then you've got depreciation recapture. You can depreciate 25% of what you've depreciated, you can defer that. And then something called net investment income tax, which is like 3.8%, depending on your investment level status. And so all of those can be deferred when you do a 1031. And some people, depending on their level of depreciation, will depreciate a property almost to nothing, buy a bigger property, restart the depreciation schedule, and do it all over again. And so these are great tools like cost seg, depreciation, 1031s that for investors, like some people I know do this, you know, in tandem, and like they're paying literally no tax, annually, right? So their exposure by the time when they sell is nothing. And so I would always talk to a tax professional, a CPA, a cost seg, there are cost segregation experts out there, and those people can point you in the right direction. But in tandem, like these things should expedite anyone's personal journey to get to where they want on a monthly income or an asset aggregation standpoint. And it's just again, it's been pretty eye opening that like people just they know about it, but like they're scared because maybe it's the numbers 1031 and all these other numbers, or abbreviations that they don't really understand. Trying to change that as being part of the 1031 industry for sure.
I like how you broke out those four levels. I think that's a little bit easier to follow for people that are newer to 1031. Another common question I hear about is basis. So, how does your basis change when you're 1031ing into the next deal? And then, how does it change if you 1031 again, or if you are utilizing a DST to 721 upread or something like that?
Yeah, like I think like the simplest way of like basis in general is like people are like, well, yeah, I bought a property for $800,000. I'm selling for $1 million. Like, 200,000 gain. Like, what do I need to, what do I need to essentially like buy a replacement property for? And so like you have to, this is like the easiest way to explain is like you have to buy a replacement property that's greater than or equal to whatever your net selling price is in order
Hmm.
to not pay any taxes. And so I think the other thing to consider is like people think it's just the equity, it's equity and debt proceeds, right? And so like proceeds are made up of debt and equity. And so if you don't replace the debt or the equity, you may have to pay taxes on whatever you don't replace. For instance, if you're selling a property for $1 million and you bought it for 800, but 400 was equity and 400 was debt, you have to buy something for at least a million, and then you'd have to, if you didn't want to replace the debt, you can also bring additional cash to offset that debt, right? So when it comes to basis, like people are like, well, my basis is this. It's like, well, you have to go off of whatever the properties kind of sells for in order to negate whatever that gain is. But I always leave basis questions to CPAs, like always, just because they have different, CPAs are kind of the source of truth, even though in the past they're like, well, you're the qualified intermediary, like you help
Yeah.
us. And it's like, well, I think from my perspective, like, you know, a lot of investors will have portfolios, a lot of properties in their portfolio. So whatever's going on at different properties at the property level, maybe it's a loss, like maybe they can offset some of the gain, right? So my recommendation when talking about basis or anything else is always reach out to a real estate qualified CPA. They will go through your scenario specific because everything is a little bit nuanced when it comes
Hmm.
to people's basis. And to even give viewers out there advice about basis, it's just once you start asking questions and learning more, it's a little bit more nuanced than what people think.
Yes, these situations can be very nuanced. Are there any, or I guess, what is the most complex 1031 situation you've come across?
Yeah, that's a great question. I would say in general, like if it's not complex, but it's happened a lot more recently, is like the reverse 1031. And so, like, a
Mm,
lot of people, for instance, are trying to, they find property because, they find property, replacement property, and they can't sell, maybe their property isn't on the market or they haven't sold their property that's for sale. And so, you know, I think over the last year, I've dealt with probably 50 reverse exchanges or inquiries. And basically, here's how it works is, a traditional 1031, you put your property on the market, you sell the property, you buy a new property, you identify that new property within the 45 days, and you have to close on it within 180 days. Well, one of your friends just brings you a really great deal, and you're like, well, great, I want to buy it now, but my property isn't on the market yet. So, like, what do you do? Well, number one, you have to be really well capitalized to be able to go out and buy the property without the debt and the equity that you need for the property that you're selling, which already eliminates probably 85% of the people out there because they need that to buy the replacement property. So once you buy your replacement property, you've got 45 days to identify up to three properties in your portfolio, and then you have to sell it within 180 days to satisfy the exchange. And so, that's something that was not the most complex. The most complex stuff I would say, Bella, is like people that want to do an improvement exchange where they buy a property, they want to do a value add with the exchange equity from the property that they're selling, and that's a little bit more nuanced. And so, like to do that from an improvement exchange standpoint, you have to have the scope of work and the planning submitted and itemized by day 45, and the qualified intermediaries, basically sets up, it's called an exchange accommodation title holder. It's an LLC, it's a trust where we basically use the funds to draw down and pay the contractors. And it's very labor intensive for the qualified intermediary. And from an operator perspective, you have to be extremely organized, and you have to have contractors that are able to do the work within 180 days and complete it. And so that's the most complex stuff. But mainly, I would say, the majority of 1031s are just standard, straightforward exchanges. Sell a property, buy a new one, because most people need the equity to, roll into a new property.
Right. I feel like another complexity is when you're in a partnership. A lot of people don't realize that unless everyone in the partnership is 1031ing, you might have to change the structure of it. So, how does the holding structure of a property affect the exchange process, and what flexibility exists for those type of scenarios?
Yeah, I think that's a really great question. And so, I think the easiest thing for partners that they're not even aware about is like, let's say you and I are buying a property. It goes in, we're both, on title, but in our own names. And then I could take my portion, you could take your portion and go our own separate way. What happens in a partnership is the IRS views each person in the LLC as unique, their tax ID number. And so when they track a 1031, each person in the LLC has to buy the replacement property because it's tracked to the LLC, right? Like everyone sets up an LLC, but the reality is like, well, who's behind the LLC, right? And so, you know, a lot of times people are like, yeah, I'm in this partnership. My buddy wants to go his own way. I want to go my own way. And so you can do something called a drop and swap, where you have to get a real estate structuring attorney involved, ideally before you sign contract. Again, this is really up to the attorney, and they are the source of truth. Every attorney has a different viewpoint of when you need to season it. Some people say you need to do this a year ahead. Places in New York now, you can do it like a day ahead, right? And so what ends up happening is you drop out of the partnership, you set up a tenant in common where you own whatever beneficial interest in the property on the deed. Let's say it's 50-50. I own 50, you own 50, and then I can take my ownership interest and I can 1031 my own way and you can do your own way. But I would say for right now, like we really need to talk to a structuring attorney. Some people will have their own viewpoints, but
Mm.
that's typically how you get out of it. But the best way to do it is to just set up a tenant in common in the beginning. You're giving yourself flexibility and options in the future for sure.
Restructuring a partnership certainly sounds ominous, but it's nice to hear that this process can actually take a day.
They just passed legislation, I guess, like in New York, where they're like able to do that. Like it's state by state, and so like some
Okay.
states, like it's really frowned upon, less than a year. And so like here's what because a lot of people do a lot of different things. Here's what I'll tell you about like the IRS. Like if you were ever to get audited, you just want to make sure that the facts and circumstances of your case support you doing a transaction that's not to just, not pay the tax, right? And
Sure.
so, you want to make sure that the intention is there. You want to make sure that it doesn't look like you're just restructuring just to restructure, which is what it really is, right? And so,
Mhm.
you definitely want to make sure that like you talk to some counsel, and if you're thinking about going your separate way, it's best to do that with talking to 1031 tax structuring attorneys across the country who are knowledgeable about this stuff.
Sure. Fair enough. Speaking of the IRS, do you think ones will be around in the future?
I mean, I would hope so. No, I definitely think there is no way 1031 exchanges won't be around, and here's why. Besides the fact that people point to politicians and their families owning a lot of real estate, like which they do, I think think about the incentive for a lot of people to sell and transact in real estate. If you got rid of the 1031, as we've kind of seen the market the market's come back this year, but the last couple of years has been a lull. Like the amount of transaction volume that would disappear would be terrible for the entire industry, and it would give no incentive for people to trade in and out of properties if every time they're going to get taxed. And so I think the last uh, iteration was the 2017 Tax Cuts and Jobs Act, which said, hey, you can't 1031 personal property, cars, yachts, paintings, all that stuff. And
Hmm.
so now it's just strictly investment real estate. But, I definitely think that we need to figure out more creative ways for policy to affect investors that are pro deal and pro investment, than put up more safeguards to eliminate any velocity, because the real estate industry, I mean, You've got sponsors, brokers, title, attorneys, CPAs. Like, think about how big of an ecosystem it is. And with
Yeah.
less deals, unfortunately, like less people are able to survive. So I would hope that they don't give, you know, anything that changes in the 1031. And, I don't foresee that happening in our lifetime at all.
Those are good points. And even with qualified opportunity zones, which are probably cousins to 1031s, is what I would label it as, that just received a 2.0 version. So that gives you positive momentum for these types of investment opportunities and tax deferral strategies. But there is certainly a lot to know about 1031s. Hopefully, this is a good start, but I think we can now end with a quick fire round of questions. The first one will be, what is your favorite restaurant?
My favorite restaurant that I miss, because I'm from Chicago, is actually like kind of like my happy hour spot. I like Guilt Bar. I
Yes,
love
so good.
those kind of chains of restaurants, but is right next door.
Yes.
I love not only good food, but I love a nice atmosphere too.
They have my most favorite carrot cake in the whole wide world. I can
Yeah,
eat the whole slice and it's a
yeah,
big one.
it's it's ridiculous.
Yeah. Second question, what is the best piece of media you've consumed recently?
Yes, I think I actually sent this to you, but we were
Mm,
talking about the Acquired podcast, and
yes.
it was I think David Rosenthal was interviewed on like the genesis and the evolution of the Acquired podcast, and why they decided to do it the way that they did, and how they effectively market and channel their partners and sponsors, and why they're so selective. And like I think a lot of times, like in media, like we're trying to all distribute podcast content, everything, but we don't really think about like the reason why that we're doing it, or the way that
Hmm.
we can elevate our partners. And so I just thought that was really interesting.
Yes, it was such a great episode. And I also like how he said it actually took years for their podcast to build. So it's literally that question of, if no one was listening, would you continue doing it? And they proved that for many years before they gained any traction. So definitely recommend that episode for anyone.
Yeah, and I think what's cool is like I think you and I talk about this offline, but like in order to do anything today, like we always think like it takes a year, like it really takes 10 years to do anything, like
Mhm.
really commit to things. And I think there's an opportunity for people that are patient out there. And, I've admired watching your podcast and having some of your guests on there and the platform that you've created that, eventually, like all of a sudden it's like, oh, like I just heard about this person. It's like, no, like I've been doing this for 5 years, 10 years. Like it took me a long time to do it. And I think like that's what I really appreciate about like learning from, folks like that, and seeing you out there, just doing your own podcast. So keep it up for sure.
Thank you. Yeah, it's not for the weak. Last question. How would you invest $100,000 today if you won the lottery?
It's a really great question. I would definitely, I'll be specific in terms of like I would keep it in real estate for a lot of reasons. I think while faster options like crypto and some other,
Hmm.
fund vehicles are interesting, I think real estate in general to me is something where I think assets are going to continue to appreciate. I think investment income is really important. And I think diversification, if you can go into a private fund or via 721, is going to be really something that I think takes off in the future. And so if I can leave you with anything, like I think 721s, we didn't really touch on it, are the way for the future. I think we're going to see a lot of investors in the next 10, 15 years, 15 years really want to get into that passive vehicle, but really transition into owning kind of like an index fund of real estate that has a portfolio of properties that perform, that kind of maintain that safe and steady income, and give them optionality to kind of over their future. So you know I think that's really the new thing that's going to happen here, like, and it's already happening. So I would go into a 721 fund, for a private fund via 721 for sure.
Real estate through and through.
Always. You have to represent. Always.
Yeah. Well, Mike, thank you so much. Why and how should people reach out to you?
Yeah, I think you should reach out to me if you want to learn more about 1031s, DSTs, really 721s. Like I like to say that I'm a 1031 expert. I helped pioneer 1031s distribution in the industry, and now I'm doing the same thing with 721 exchanges. And I think the most important part is, you know, the best investors and the best people I know educate themselves on options. It's not necessarily,
Mm-hmm.
having the right option for them at the same time, but it's at least letting them know, like, hey, like I never thought that this existed. Maybe it's good for you. Maybe the timing isn't right, but at least like there's some flexibility and some options that people have in the future. And I'm happy to go through and talk with people about that.
Absolutely. I hope that's what people got from this podcast. I hope they just know that this is an option out there and this episode is a good first step, but there's a lot more digging to do. So they can reach out to you or to me to learn more, or at least we can funnel them to the right people. So thank you again for your time. Until next
Yeah.
time, adios.
Thanks for having me on.
Thank you for tuning in today. If you found any value and want to support the podcast, I would be forever grateful if you texted someone the link. You can say that you have a podcast episode that may be interesting for them. Also, if you have questions or topics you want covered, please don't hesitate to reach out on LinkedIn or Instagram. Remember that every step makes a difference. I hope that you continue to learn how to get richer and stay that way.